Let's bring in Julia Coronado, founder and president of Macro Policy Perspectives, to weigh in on these messages. Julia, it's a resolute one across the board, seemingly. Chair Powell just consistently reluctant to declare victory on the inflation fight. Everyone else acknowledging some structural reasons inflation might stay high and therefore rates might have to go higher. Markets seem accepting of this. Are we taking them on their word and that this is working?
Yeah, so, I mean, they all struck a unified hawkish tone on the one hand. On the other hand, they all kind of acknowledged that they don't think they're far from where they're trying to go. So Chair Powell emphasized how much they've done, that one of the reasons for skipping June was just they've done so much that now they're sort of slowing down and seeing whether they've done enough. So the idea that they've got another rate hike, 2, maybe even 3, wouldn't be as damaging to market sentiment, especially given why they're doing that, which is that the economies and the labor markets across the globe have just been tremendously resilient.
For sure. He did emphasize the element of time. So, a prolonged period of time with rates up in this area perhaps is what's going to be this next phase of seeing if we can restrain the economy. Have we learned anything about the interplay, though, of unemployment, inflation, and Fed policy over this period, that in fact unemployment is down as we've gone up by 5 percentage points in rates?
Yeah, and what's really striking is that is a dynamic that is not unique to the U.S., that Governor Bailey talked about the same. The European continental labor markets are seeing the same thing, something we refer to as labor hoarding, which is the idea that given how hard it was for companies to staff up during the peak of the labor market, they're inclined to hold on to their workers for longer, even as revenue growth slows. And that could give the economy and labor markets more resiliency. That could facilitate the hoped for soft landing if we can strike that balance, bring the inflation pressures down. And Chair Powell ended on that note. That was the optimistic tone when Sarah asked, what gives him hope? He said, this has just been a really resilient labor market, and that gives him hope that they can bring inflation down without too hard a landing, or he said too extreme a rise in unemployment. So that's the good news coming out of all of these economies.
For sure. Yeah, he also did seem to give a nod in the direction of some of the forward indicators of inflation getting a little bit more friendly, the shelter-related costs and things like that. That's something the market likes to hear as well. What role do you think the sort of regional bank stress we saw a few months ago has in the Fed's thinking, and then even into the economy in general? Are we waiting for that shoe to drop?
Yeah, I mean, that is something Chair Powell was very clear about today. He was clear about it in his congressional testimony last week, that is one reason that they paused rate hikes in June, that when we see a period of bank stress like we've seen, you tend to see a wave of credit tightening above and beyond what you'd get just from higher interest rates from the Fed, but that it takes some time for that to unfold. So they haven't seen it yet in the data, but you wouldn't really expect to have seen it yet. So by slowing things down, that gives them some time to see whether that is, in fact, going to materialize and do some of the work for them. He was pretty clear that, at least for him, and he said, which kind of reflects there might be a divergence of views on the committee, he said, at least for me, that was a reason that we didn't raise rates in June.
Right. Now, the market has at times been reluctant to give up the idea that rates would probably be on the downswing before very long. Now, some of those perceived cuts or anticipated cuts have come out of the market. Do you read that as essentially a recession call by the market, or is it just that's the direction where the risk lies right now, and so you have to account for it?
It's really hard to parse between those scenarios when you're looking at the forward curve and interest rates. The curve has sort of leveled out for a longer period before those cuts kick in next year. I think that's more in line with the Fed's sort of baseline scenario of a gradual soft landing. But it could also be consistent with a recession that kicks in turn of the year, early next year. and leads the Fed to cut rates. So it's hard to parse between those just looking at the curve itself.